Well, hello everyone. This is week 6 of this microeconomics class. I'm sorry, international trade class. We will continue with the discussion of international finance that we started last week. The first thing is to see how the exchange rates are connected with different aspects of the economy. So see what happens here. For example, this is, as we saw before, chart reflects the supply and demand of euros. So how many dollars you have to pay to buy 1 euro, and how many euros you could buy. So based on this, you have the supply of euros and the demand of euros. And what this chart shows is a very specific case in which there is no other financial connections. We are only talking about trade here. So you have two countries that engage in imports and exports, but there is no financial flow. So this is only to connect which is the connection between the exchange rate and the trade flows. As under these assumptions, the demand for euro will be driven by the U.S. demand for European market unit goods and services. So, if an American in the U.S. Wants to buy European products, will need to buy euros first. So, and this will drive the demand curve. And the opposite is when Europeans want to buy American goods, they will need to sell euros. So consequently, you have the supply and the demand, and the equilibrium is where both lines converge. So, and this is an equilibrium not only in the exchange rate, but also in the level of trade, imports and exports. So this is where both balance. So the question is, what happens when, for any reason, the conversion rate, the exchange rate is lower? In this sense, you need to less dollars to buy a euro. So this is an appreciation of the dollar. When you appreciate the dollar, for American people, need they will foreign products will be cheaper, so consequently you will have more imports, and domestic US products will be expensive for others, because what you have here is that the dollar is more expensive than in equilibrium. So at the point A, the dollar is more expensive than at the equilibrium point. So consequently, in this point, exports will be lower and imports will be higher. Consequently, you will have a trade deficit. You see, trade deficit will not close. So the only way to return to a balance is just to release the dollar. If you release the dollar, it will automatically go back to the point B. And the chart explains you why. Is that if the dollar is appreciated, so it's more expensive than in the balance situation, in equilibrium situation, you will have more imports into the US. So in this simple example, all the imports will come from Europe, and in that case, Americans will need to buy euros to buy European products. So consequently, the demand for euros will be larger, than in the point of equilibrium. And the opposite is, since the dollar is expensive, it is Europeans will not buy American products because they will become expensive. Consequently, the supply of euros will fall. So consequently, you will have this situation out of balance. What is interesting is when you incorporate the concept of elasticity of the dollar, or elasticity of the, well, in this case, elasticity of the euro, elasticity of the supply and demand of euros, if you want. So you see what is interesting is what happens if the two curves are more inelastic. For whatever reason, it becomes more difficult to buy the euros. In this case, you will see that the gap will be even worse. So consequently, you see that this equilibrium goes from A to C. You see, so consequently, the trade gap. It means the level of imports will be even higher, and the level of will grow more, and the level of exports will fall more than in the previous case. So this gives you like incorporating another variable that is elasticity. The interesting thing is that you incorporate the concept of elasticity, and you see that there are other situations. For example, normally the supply curve is upward, slow, but in this case it's downward. For whatever reason, it can be expectations about the future of the euro, whatever. So remember that technically sometimes the supply of a currency can be just a vertical line, because the government can provide all the currency. The European government can provide all the euros as necessary. So it is not absurd that you have a situation like this. So what is interesting is that in this situation you see what happens in any point. Let's say this point here. So let's say that this is the amount of euros that is supply and demanded. So, and for this amount you see that the price of the demand is larger than the price of the supply. So people are willing to pay more than what the supply is offering. Consequently, you see that the price is diverges. It goes up. So consequently, this produces a larger gap in the value of the currency. That leads to a depreciation of the dollar, of the euro, of the dollar. I'm sorry, depreciation of the dollar, because it goes higher and higher and higher. Consequently, this leads to a more important imbalance, if you want, because the more you devalue the dollar, the more you go up. It means that the more the cheaper the dollar exports become. Consequently, the US will export more, and the more expensive the imports from Europe will become. So the US will import less products from Europe. So this widens the trade gap in favor of the US eventually. This chart says the same actually. So the point here, the interesting thing, this is the Marshall-Lerner condition. And the key issue here is that, as we have just seen, is that if we devalue, if we reduce the value of the nation's currency, so the dollar gets weaker, as we saw. Remember in the chart, we saw that the dollar number of dollars to buy 1 euro goes up. It means that it's getting weaker. However, it doesn't necessarily change the trend, the balance of trade immediately. So, and there is empirical evidence that this is true. In other words, that a currency depreciation uh, supposedly improves the trade superavit in a country like in the US. However, this improvement may take time. There is a curve that is like a J curve, so it's a curve like this. So initially, the initial effect can be that the country may not raise the amount of exports with a devaluation, but continues having the same level of imports. So consequently, initially you may have a fall in the trade balance, and then after a while you can have an improvement in the trade balance. This is just a matter of time. So in the long run, the devaluation will impact positively the trade balance. So the country will export more and import less, but it may take some time. This is what this J curve impacts. Okay, so there is other issues that I'm going to skip, because I want to focus only in the part that is quantitative. Remember, so the purpose of this discussions are to focus on the quantitative part. You can read on the textbook all the rest. That is relatively friendly, so you can get them much better. Otherwise, this presentation will take hours. So for 40, 50 years in the turn of the previous century, between 19th and the 20th century, the world adopted a gold standard, and a gold standard is a fixed exchange arrangement. So, and this fixed exchange it means that you have all the disadjustment that I mentioned in the last class. Is that it may eventually end up in a run on the currency. I will explain that again now with a graph in a couple of slides. So the gold standard and the fixed exchange system demonstrated that this is very vulnerable to speculative attacks, because the amount of money, if you want, that is floating can go to one country and then can go to another, and the having a fixed exchange rate system produces a lot of distortions in the economy that can be very serious. Okay, so then we get into another discussion that is interesting. Remember that we mentioned a couple of slides ago that we were assuming that in this mini economy that involves the US and Europe, we were only considering a trade. We were not considering other aspects like where financial flows are involved. Now we are going to incorporate these financial flows, and let's see what happens in the economy when you incorporate these financial flows. This opens the discussion to this chart that I'm going to show you afterwards. So the first thing is that if this is the GDP of a country, if you want, so the output, this is the consumption, and this is the level of saving, and saving should be equivalent to the investments. So the money that leaks from the economy, from the real economy, and moves into the financial sector, the savings, should be the same as the money that also moves from the business side back into the economy by way of investments. So I is investments. So consequently, S and I should be identical, you see, because otherwise the money has to go somewhere and has to come from somewhere. So this leads to the following rationale. This model, you're assuming that the investments are autonomous. I mean, business people decide the level of investments and can change from year to year. But savings is something that is relatively structural. So it's a percentage of the income of the people is saved by the people. This is called the marginal propensity to save. In this open economy with a flow of funds, you not only have leakages that go uh, from the economy to the financial sector, you also have leakages that go overseas. In an open economy, inputs are a new leakage and exports are a new injection of money. So in the economy, you have a money that goes in and out from the financial sector, and money that goes in and out from the external sector, if you want. So altogether leads you to this equation in which you have the savings, the investments, and you have imports and exports all together, and all of them impact on the amount of money that gets into the economy or leaves the economy, abandons the economy. So eventually these changes depend of the propensity of the economy to save, the propensity to invest, the propensity to import, and the propensity to export. These are all the variables, and this changes according to countries and according to times. What is interesting in this thinking, if you want, is that assume that nation one experienced an increase in its planned autonomous investment. So the autonomous investment impacts on the Y, on the income of the economy, and this Y impacts on the imports. So if the investment goes up, the the Y, the GDP, the output of the economy goes up, the income of the people goes up, consequently the imports go up. People have more money, people import more. So there is a propensity. This M is the propensity of the economy based on the output or the income. Is a propensity on the economy to import, and these imports is a leakage of money that goes to nation 2, and nation 2 will have an impact on the income of the population, and once again they will have this will impact on the propensity of the economy to export, etc., etc. So consequently, you see how all these decisions have an impact on the nation and the foreign nation, and the implication of the foreign nation have an implication of domestic nation, and so on. So here you have all these variables if you want. Uh, Imports, exports, consumption, net savings or investments. So, and then you define two concepts, what is called the domestic absorption, that is basically all the inflow of money in the economy. Some is coming from the domestic market, consumption plus investments, consumption from the public and investments by the business sector, and the foreign absorption, that is the difference between exports and inputs. So Y, that is a GDP, that is the output of the economy, depends on these both absorptions, that is basically flow of money coming from one sector or coming from the foreign sector. So depreciation of money, of currency, is expected to increase B if you want. So the conclusion is that if the economy is in full employment, Y cannot increase. So consequently, in a depreciation, remember that B increases, so A is going to increase too. So this is kind of the conclusion, if you want, is that when you devalue the currency, you will have an improvement in the exports. The company will export more than what it, and exports will raise and imports will fall, and this will impact in the domestic consumption plus investments. So the conclusion is practically what I told you, is that the capacity of the country to absorb these devaluations goes to wages to profits, or from wages to profits. Depreciation increases prices and hence lowers domestic expenditures, and depreciation pushes people into higher tax bracket and hence lowers disposable income. In other words, there's a whole set of things that change when you produce a devaluation. And now I'm going to show you all of these into one graph that is not provided by this book, it's provided by another book, but I think it's interesting that you see everything in a graph, because so far everything is more conceptual, more descriptive, but you don't know exactly what goes on. So fix a flexible exchange rate adjustment, that is what we have today in most of the world except Europe. The entire block of Europe is having a fixed exchange rate, which is very dangerous if you want, because the fixed exchange rate has demonstrated that it cannot adapt to changes in all these variables that we mentioned, and leads to financial speculation. It is very serious, and in the past produced large disasters. So there is a lot of expectations to what's going to happen in Europe if Europe can resist having a fixed exchange system. I will show you in the model that we will see in a couple of slides that fixed exchange arrangements, like the case of Europe, it has a vulnerability, and the vulnerability is that the country cannot have a fiscal deficit above the international inflation, because the fiscal deficit produces inflation, and in the domestic inflation is higher than the international inflation. It necessarily leads to a financial collapse. So conclusions: flexible exchange rate adjustment. Trade deficit leads to a depreciation of domestic currency. We know that. Depreciation spurs an improvement in the balance of trade. We know that. So if you devalue the dollar, it's cheaper to buy American products, and it's more expensive to buy European products. Consequently, this improves the exports and reduces imports. The improvement in balance of trade spurs increased domestic production. It's obvious, but all the exports might be produced locally. The increase in production generates increased domestic incomes. It's obvious. So the increase in the local production raises the income of the people, and this generates larger investments. It's obvious, because part of the money of the enlarged income goes to savings. These savings must have a counterpart in investments, in business investment. So, okay, if production cannot increase because the nation is already full employed, the domestic absorption must fall. Okay, so this is practically what we said. fixed exchange adjustment is the opposite. Trade deficit spurs a decrease in the domestic money supply. This seems a little bit abstract. I'm going to show you now the model. Finally, after promising, I'm going to show you now the model. So this is the objective of one country, that is, having a balance, internal balance in terms of GDP, employment, inflation, etc., etc., and an external balance, that is the balance of trade. So to have both a compensated balance of trade and balance of international funds, a capital account. Okay, based on this, to have a sustainable rate of economic growth, distribution, and environmental aspects, whatever. Okay, so let me show you this graph that I mentioned a couple of times. This comes from the book International Economics from Paul Krugman. It's not in the textbook that we use in the class, but I believe that if you don't know this chart, you will not understand much of what we are talking about, because uh, there are too many conceptual definitions, but I think that this model is outstanding in putting all these definitions in only one place. First, this part of the chart is something that you know very well. It's exactly what we have been using so far. That is, this is the exchange rate, I mean the conversion rate between the dollar and the euro. So it means that if you go up, it means that you need more dollars to buy 1 euro, sorry. So this is a devaluation, and this represents the domestic currency of foreign currency deposits. So it's the I'm sorry, the interest rates in Europe, if you want, of dollars in Europe. Then underneath you have another chart. There is something that you also know very well, that is the connection between the interest rates and the money supply, the money holdings, M. And what you have here is the level of Y, the output of the economy. So consequently, what you have here is practically all the economic variables in one slide. And this is very interesting, because in this case, what you see is that what happens when you devalue the currency. You see, when you devalue the currency, you come all the way here, is that you reduce the domestic interest rates, and you can produce enlargement of the monetary base, or you can produce you have to look at the whole chart. No, initially this is the initial level of monetary base, or money supply, and if you come here, this line goes all the way up here, so you produce a monetary expansion. So this is kind of the variables. And another impact that this may have is on the level of GDP, because when you expand the money output, if you want, this can produce an expansion of the output of the economy. This is very interesting, and this practically explains everything that comes after this slide in the textbook. And if you get familiar with this slide and you spend some time, for example, in this case, it shows what happens when you have a fixed exchange rate. So that is the number of dollars per euro, stays absolutely fixed. Consequently, what happens when you have other aspects? Let's say that the country gets foreign debt, and based on this expands the money supply. Consequently, you will have an expansion of the economy plus inflation. It continues expanding the monetary base, you will have an expansion of the output plus inflation. So consequently, what happens when you keep on adding up inflation, and it gets higher than the international inflation? What happens is that the country becomes uncompetitive, the domestic product, the US product, become more expensive, and consequently one day the country cannot export anymore and has an invasion of imported products. So this leads to a fall in the domestic GDP in the US, and this leads to unemployment, recession, etc., etc. So sooner or later the country has to abandon the fixed exchange rate. This is exactly what may happen in Europe between Greece and all the other countries. So eventually the only way to solve the Greek crisis or whatever is to abandon the euro and let this conversion rate, exchange rate or whatever, fall free, and consequently the devaluation will make the Greek products more competitive with a lower price, and this will lead the entire system into equilibrium again. And this is practically what the rest of the chapter says. So and I will try to go fast because practically that explanation that I gave you solves everything that you see, and then after that. So you see what happens when you recognize that there is some monetary and fiscal policy. So the policies are practically monetary and fiscal policy, and when you have this monetary and fiscal policy, as you showed in the previous slide, you may impact on the produce an expansion of the money supply, as I show you in the graph, an expansion of the money supply, and this may create the need for devaluation, because when you expand the money supply, automatically you produce inflation, and the inflation leads to the need to uh, devalue, because if you don't devalue and you have internal inflation, then automatically foreign products imports become cheaper, and uh, exports of the domestic products become more expensive, and consequently it leads to recession and it leads to unemployment. So then you have the alternative of controls, but the controls on tariffs or whatever, you know very well that produce retaliation. So if one country has starts stopping imports artificially by way of different type of control, automatically the other countries will retaliate, and this is clearly unsustainable, if you want. The rest of the chapter I'm going to skip it because it's relatively practically what I mentioned in this chart is what happens when you start having imbalances, as I mentioned. That is, inflation leads to loss of competitiveness, and consequently this leads to a problem in the balance of payments, that people start abandoning the currency because they expect a devaluation, and this leads to complete chaos. Then you have some solutions. I mentioned the solutions before. I think practically what I told you is summarized here. So okay, this is it. I lead you to read this. That practically is this chart that I show you. And if you have any doubt, please don't hesitate to give me a call. Thank you.